Good morning, ladies and gentlemen. I'm Fu Boon Ping, the Managing Editor of the Asian Banker. I'm pleased to welcome you to this teleconsultation on stress testing and capital planning, the Federal Reserve's approach. We are very happy that we have senior members of the capital analysis team at the Federal Reserve Bank of San Francisco, Ms. Christina Sally and Ms. Anne Barron, to share their experience and insight with us this morning. Before that, let me give a brief background to our discussion topic this morning. The global banking landscape has undergone significant changes in the last few years following the financial crisis. Asia-based banks, while appearing to be relatively insulated, are nevertheless subject to the wrath of new regulatory changes and a more risk-conscious regulatory environment and framework. Banking regulators across jurisdictions are emphasizing the use of stress testing of financial institutions as a supervisory tool to avoid repeat of the crisis in the future. The stress testing approach differ by jurisdiction and financial institution, but are all intended to provide regulators and bank management with a picture of how financial institutions will fare under different stress scenarios, and what steps must be taken to prepare for and to mitigate those possible scenarios. In Asia, the efforts of conducting stress testing on a regular basis have gained momentum in the last few years. Major East and Southeast Asian economies have all started with various sensitivity tests immediately after the 1997 Asian financial crisis. At the early stages of implementation, the stress testing for these economies was done externally by the IMF and the World Bank as part of the Financial Sector Assessment Program. However, since late 2006, the central banks and monetary authorities in the region have begun to implement basic modification of the stress test model. Prior to 2007, the sensitivity stress testing techniques was predominantly employed. Only in 2008 and 2009 was different scenario testing explored to test various risks, such as credit, liquidity, and market risk by the central banks and monetary authorities in East and Southeast Asia. Stress testing, therefore, is an essential part of a bank's holistic capital planning process. It will help a bank define its risk appetite, capital buffer, and sensitivity towards adverse conditions to determine capital adequacy. Defining an organization's risk appetite is important in order to align its strategic business intent and operations, as it will help it define the amount of risk it is willing to take to achieve an expected goal. Stress scenario development is the most important process when conducting stress testing. Today's teleconsultation will discuss the evolution of the U.S. Federal Reserve System's stress test program since 2009, targets for the quality and level of capital needed by banks, the role of bank supervisor in setting those targets and requiring action to achieve them, and some of the high-level findings and lessons learned by the Federal Reserve in this ongoing supervisory process. To give us a regulator's perspective on this topic, we have Christina Sally and Anna Barron from the Federal Reserve Bank of San Francisco. They both work on the capital analysis team on capital planning and stress testings of both regional and large banking organizations. Christina is a senior examiner. She has worked in bank supervision for the Federal Reserve System for 8 years, both in New York and San Francisco. In New York, she worked on the market risk control traded product teams, the AIG financial product monitoring team, the Goldman Sachs on-site team, and on the operational risk governance team. Anna is a senior analyst. She leads and advises on assessment of capital planning, stress testing, and model risk management practices at large and regional banking organizations, including capital plan review inspections. Prior to joining the Federal Reserve, Anna was a manager in financial services risk management advisory practice at Ernst & Young. Christina will start today's session with an overview of the Federal Reserve's stress testing program and its evolution in recent years, while Anna will talk about the capital planning process and the role of supervisor in setting targets and action plans. And together we will explore the lessons learned that Asian banks can benefit from. There will be Q&A throughout their presentation. We request that callers keep their questions focused on the topic of stress testing and capital planning, and not on other areas of regulation or compliance. To ask a question, you have two options. You can write your question into the chat box at the bottom right corner of the WebEx screen, or you can press the hand icon below the list of attendees in the right column of your screen. This will register your intention with us, and we will open the line for you to ask your question directly. So let me introduce now Christina to give us an overview of the Federal Reserve Stress Testing Program. Christina?
Yes, hello. Thank you very much for the introduction, and thanks to everybody for joining us today. So as Boon Ting said, Anna and I are on the capital analysis team at the San Francisco Fed, and we focus on mostly capital planning and stress testing for firms over $10 billion. So we'll be discussing today those practices and what the Federal Reserve's approach has been since about 2009. So if you turn to slide 2 in the presentation, we start off with just a description of what is stress testing. Stress testing is a very broad statement and has many meanings, but the basic objective is just to determine what if a negative event occurs and what impact that would have on a banking organization. And in our capital planning work, we're most concerned with what the impact on capital levels are given a negative event occurring, such as large loan losses or trading losses or lower revenues. So as we say on the slide, the purpose of the stress test is to ask what could go wrong and what effect would it have. And throughout the past few years, supervisory expectations have been evolving greatly, and institutions are expanding their use of stress testing. And we'll go through during the presentation how that's evolved. So turning to slide 3, this slide gives you an overview of the evolution of stress testing and capital planning, and this is basically what the presentation is about today. So to go through the timeline, starting in 2009, we started something called SCAP, the Supervisory Capital Assessment Program. And yeah, as you can see from this slide, I'll apologize now, we like to use a lot of acronyms at the Fed, so hopefully we've defined them and you can keep up. But what we call SCAP is the 2009 stress test that we began with, and that was as a result of the financial crisis in 2008 to basically determine if banks were holding enough capital to be able to withstand the crisis. And this was then rolled into something called CCAR that we started in 2011. This is the Comprehensive Capital Assessment and Review. And CCAR was for all firms over $50 billion and the largest 19 firms. And starting in 2012, we added firms under the CAPR review, the Capital Plan Review's CAPR. So between CCAR and CAPR, that's all firms over $50 billion, and that captures a total of 30 firms in the U.S. In addition to that, we issued a supervisory letter in 2012. So it's called SR 12-7, which is guidance on stress testing, which is for all firms over $10 billion. And then the Dodd-Frank Act, part of that was the Dodd-Frank Stress Testing Act, and that formalized stress testing requirements for all firms over $10 billion. So one big difference to note on this slide is that, again, CCAR and CAPR is for firms over $50 billion, while Dodd-Frank and the stress testing guidance is relevant to all firms over $10 billion. So these are the different processes we'll talk about throughout the presentation today. So if you turn to slide 4, this just shows you basically the results of the efforts that the Federal Reserve has done since 2009 between SCAP and CCAR to ensure banks are holding enough capital. So as you can see in 2008, the buffer over the Federal Reserve's well-capitalized minimum of 5% Tier 1 common was really small. It was barely over 5%. But if you look now towards the end of 2012, that's increased to almost 12%. So you can see the results of the efforts that the Federal Reserve has made with these processes that we've been holding. So if you turn to slide 5, we'll begin talking about the SCAP, which is the initial assessment we did in 2009, which, as I said, the purpose was to determine if banks can weather the financial storm that started in 2008. So the scope of the review is the 19 largest firms with assets over $100 billion. and with the goal of promoting stability and confidence in the financial system. And as a result, a lot of, you can see the results here, for most of the banks, dividends were either reduced, repurchases were halted, and many of the firms had capital injections as a result of the SCAP exercise, and that really helped to promote confidence in the financial system. If you turn to slide 6, this shows you an example as to the loss rates that were used in the SCAP exercise. So we went back to 1921, as you can see here, and used a loss rate of over 9%. The SCAP loss rate was 9.1%, which was higher than what we saw even in the Great Depression. So this just shows you how severe of a stress the SCAP test was. And we really wanted to, again, stress the banks to ensure that they can withstand a severe recession. Turning to slide 7, this shows how we moved on from that initial SCAP exercise to what we call CCAR, the Comprehensive Capital Review, and Dodd-Frank. So after SCAP, the Federal Reserve basically asked ourselves 2 questions: is how do we continue to evaluate future capital distributions, and how do we ensure capital positions are sound on an ongoing basis at the largest banks? So we developed something called the Comprehensive Capital Analysis and Review, which we call CCAR, and this is for banks over $50 billion, and we require them to submit an annual capital plan, which includes stress testing, and the capital plan has to determine pro forma post-stress capital levels and capital ratios. So this is to determine if banks can weather another recession and see what the results are. So after the CCAR review, again in 2012, we issued that SR 12.7, the guidance on stress testing, which is for all firms over $10 billion. And then also, like I mentioned before, the Dodd-Frank Act formalized the stress testing requirements for all banks over $10 billion. So turning to slide 8 now, we can take any questions that we have up until this point.
Christina?
Yes.
Hi, Christina. We have a couple of questions. First, why are banks expected to conduct stress testing as part of their capital planning if their capital levels already exceed regulatory minimum? So I'll let you answer that before we move on to the next question.
Sure. So, so looking at current capital levels, they're really just a point in time number, and they're so they can be very backward-looking, while stress testing is much more forward-looking. And the standard capital ratios, since they're just point in time, they're not necessarily a good measure of solvency in the firm, and they're also they're not as comprehensive and have an incomplete coverage of risks at the firm. And stress testing is a lot more comprehensive. It includes different, like I said, loss estimates and estimates of revenue, and it's much more comprehensive and forward-looking. So, you know, we make sure banks are above regulatory minimums, but it's not enough. We want it to be forward-looking to see if they can continue to be above regulatory minimums, even if they suffer severe losses.
And the stress tests at this juncture are done mainly from a top-down approach.
So it depends what you mean by top-down. They're done in a variety of ways. They're both done, so the firms themselves can do them top-down, where they start at an enterprise-wide level and, you know, apply loss rates to different portfolios. But they can also do them bottom-up, where, you know, some of the larger banks that have enough data can do bottom-up stress testing, where they can start with loan-level data and then aggregate it up to an enterprise-wide level.
Right. So are there plans to develop stress testing requirements for firms 10 billion or less in the future? And will foreign institutions be required to comply with the stress testing requirement?
Okay, that's a good question. We get that one a lot, especially from the firms under 10 billion. So no, the Federal Reserve does not plan on requiring stress testing for firms under 10 billion. We actually issued a statement in May of 2012, I believe, that the U.S. banking agencies together, along with the Federal Reserve, issued a statement to this effect that there is no plan on requiring stress testing on firms below $10 billion. However, there are a variety of SR letters that we've issued over the years that are for portfolios such as commercial real estate and interest rate risk, which discuss stress testing as a useful risk management tool for those portfolios. And I think we have a slide on that later in the presentation, so you can see towards the end where there are other SR letters that require stress testing, but it's not something that's required generally. And as for foreign institutions, the current stress testing rules do not apply to FBOs, but the board issued a notice of proposed rulemaking, an NPR, on stress testing, which would apply it to FBOs over $10 billion in the future. So a final rule should be issued soon on that. Right now, it's just out for comment.
Right. Are there so time frame for that?
I do not have a time frame for that. Sorry. The board has issued the proposed rule, and then they get comments back, and then they take those comments. So it depends on how many comments they get and how long that takes to take into account before they issue the final rule.
Okay. Thanks, Christina. Now, Anna will talk about the role of the supervisor in stress testing and the processes involved.
Thank you,
Anna.
So as part of the CCAR submissions, bank holding companies are expected to demonstrate that they have the following processes in place. So the first is establishing and following an internal capital plan. And capital plans are supposed to have a number of elements. First, they're supposed to have an assessment of the expected sources and uses of capital. They should include a description of the planned capital actions. Capital plans also should include a discussion of the expected changes in the business plans of the companies that may affect materially their capital adequacy. Capital plans also should describe bank holding companies' processes for assessing their capital adequacy, and they should include a comprehensive capital policy. So the second is establishing bank holding companies' stress scenarios. Banks are expected to go beyond regulatory scenarios and target their own unique concentrations, positions, and idiosyncratic risks that may pose vulnerabilities to their capital position. Bank holding companies should demonstrate that they have robust processes for developing those scenarios. They should have those scenarios as severe to their own risk profile and capital position as the supervisory stress scenarios are severe to the overall industry. And the last thing to note is that the stress scenarios that the companies develop as part of the CCAR submission are just a subset of the broader stress testing programs that companies should have. Moving on to reporting, for supervisors, companies submit a set of Y14 regulatory reports that include data elements on their capital position, balance sheet, income statement, describing their loan and securities portfolio, and this data is being used by supervisors for the horizontal benchmarking and also for the independent supervisory modeling. The companies also provide disclosures to the public that meets the requirements in the Dodd-Frank Act stress testing. Lastly, companies are required to have models, an overall modeling framework that meets the expectations, supervisory expectations for model development, documentation, use, and validation. So moving on to slide 10, capital plans are more than stress tests. Capital plans go way beyond stress tests, and they should, and just as I mentioned on the previous slide, they include a number of elements. This page lists some of the key elements that should be part of the capital plan. Capital plan should include targets. So in addition to companies being subject to regulatory capital minimums, companies should also set their own internal capital targets. And those targets get set based on a number of inputs. First of those is a stress test, as we just discussed. Stress testing broadly should incorporate and cover all material exposures and risks of the company. And also, they should take into account the expectations of key stakeholders when setting their internal capital goals. Capital plan also would include capital policies. Capital policies include in themselves the various targets and goals that companies set. They include capital conservation triggers. They include the roles and responsibilities of the key decision makers. The capital plans should also include description, as I mentioned, of the capital actions that the companies are planning to undertake. Capital actions would include either issuance or repurchase or buyback of various capital elements, including dividends as well. And lastly, companies should contemplate and consider when evaluating their capital position any future capital requirements. In this case, the example is Basel III regulatory minimums that get phased in over extended period of time should also be considered. So moving to page 11, we'll look at the role of supervisors in CCAR. This is a list of some of the key activities and roles that supervisors and the Federal Reserve plays in the CCAR process. We'll discuss each of those roles and activities in more detail on the following slides. So the first, if we move to page 12, will be the first two roles. The first two activities are setting regulatory capital goals and developing publishing scenarios. So in setting regulatory capital goals, regulators define, obviously, the regulatory minimums that the company should stay above. And in the case of stress testing and CCAR broadly, companies are expected to stay above regulatory capital minimums after stress. So after they run their stress test, they should stay above those minimums. Developing publishing scenarios, regulators provide, Federal Reserve provides supervisory scenarios once a year. Those scenarios are defined in terms of levels and paths of various macroeconomic variables. The companies are allowed to supplement those variables provided by the Federal Reserve by additional variables that may be applicable to their unique risk profile. If we look at the page 13, this is an example of a macroeconomic variable that is included in the supervisory stress scenario. Real GDP growth rate, you'll see in a solid line is the actual path over the last recession and before, and then the dotted line is the path prescribed in the severely adverse scenario in CCAR. So you see that there's a pretty significant shock that was given as a stress scenario. Looking at page 14, this is another example of another variable, unemployment rate. Again, you can see the history, the actual, and also the path prescribed in the scenario is the dotted line. And lastly, we should turn to page 15, the National House Price Index. Again, you can see that the path that this index variable followed historically, and then the path that was given as part of the scenario by the regulators last year. I think we can now turn to page 16. Thank you.
Okay, and we talk about how important the stress test scenarios development are, and in terms of how important it is that they reflect future adverse condition and how plausible those conditions may be. How many stress scenarios are banks expected to develop internally versus the ones that are prescribed by the Federal Reserve?
This is also a good question that we get asked frequently. Beyond the scenario that is provided as part of the CCAR submission, companies are expected to conduct a broader range of scenarios. Those scenarios should include various specific idiosyncratic risks, something that's unique to their profile, maybe to their geographic concentrations or their risk, industry concentrations, etc. It's very hard, and in many cases impossible, to capture all their risks in one single scenario. The scenario will be very hard to make it meaningful. So that's why it's expected the companies conduct a variety of macroeconomic stresses, just operational stresses, and other type of contingency analysis.
Okay, I think we have one more question. When you talk about stress testing for bank holding companies, do you believe the single point entry method is stronger or more reliable than the multi-point of entry method? Okay, this comes from a caller. Would you be able to share some light on this?
If you mean in terms of a complex legal entity structure that includes a bank holding company and also various subsidiaries, we expect that companies conduct stress tests at various legal entities. So if they have multiple legal entities that are subject to various separate regulatory capital minimums and also have their own unique risk characteristics, we would encourage and expect companies to conduct either, well, both the enterprise-wide stress test, but they can also do it on a more granular level. They can do it at a legal entity level. They can do it at a portfolio level as their specific legal entity structure and risk profile warrants.
Okay, thanks for that. So continuing the presentation, I believe Christina will be talking about the next few points. Christina.
Yes, thank you. So the next few slides talk about the disclosures that are required as part of the CCAR process. So slide 17 talks about what BHC is required to disclose after the CCAR exercise. So the first thing we require is a description of the risks that are captured. So they should talk about the most significant risks, how they're captured in the exercise, and then more importantly, which risks are not fully covered, which could be for reasons of, that they're either immateriality or maybe they're immeasurable and, non-quantifiable, but, it's important for them to describe which risks they are not capturing in the stress test. The next thing that we ask for them to disclose is a description of the methodologies used. So, how they're translating the macro variables that are provided by the Fed in the scenario, and then what methodologies are used to estimate losses. So, for example, if they're using a rating transition model or a PD/LGD approach to estimate loan losses in a particular loan portfolio, that's the type of information we expect them to describe in the methodology section. The next bullet talks about an explanation for the changes in ratios. So we want them to, talk about what has the largest impact on capital levels. So it could be loan contraction leading to a reduction in risk-weighted assets or something, or where the largest loan losses were in a particular portfolio because of certain portfolio characteristics, or if there were trading losses, if they have a large trading portfolio. So basically an explanation of where the largest losses or revenue generators are that are resulting in the biggest changes in capital ratios. Next, we look for an explanation of capital actions, what distributions they're planning, and what their capital goals are, and what they, plan on, what buffers they plan on keeping going forward. And then lastly, any other information on governance and model risk management, model validation practices, and benchmarking, and then information that senior management provides to the board and how the board is involved in setting capital goals and ensuring that senior management is involved in the process. So moving on to slide 18. This now shows the type of information that the Federal Reserve discloses at the end of the CCAR process. So while slide 17 talked about what the bank itself discloses, this slide talks about what the Fed discloses. So the Fed puts out 2 papers after the CCAR exercise is complete, and which one of them gives detailed modeling results. So the Federal Reserve uses their own models to come up with their loss estimates and capital ratios. So we give some information about what the stress losses are by loan type and stress revenues, net income, capital ratios, and that type of information. And the purpose of this is really to provide the public with both an independent view of what the stress losses can be at these firms and what can happen to the capital ratios, to also provide a horizontal perspective across the firms. And this has really helped give the public insight into the process and how we make our decisions as to whether we object or not object to a firm's capital actions. So we provided a link at the bottom of this slide, which is a link to the board's website on capital planning and stress testing. So it includes a lot of information, and one of the things that's there is the disclosures that the Fed has made after the last two CCAR exercises. So you can go there to see those disclosures. If you move on to slide 19, this is an example of what was in the disclosure. So the paper that the Fed put out that talks about the internal models. This is one of the graphs that was in there. So this is just an example of the type of information that's in those disclosures. So this shows you the 19 firms that are in CCAR and the impact of the loss estimation and the revenue generation process has on the capital ratio. So the red bar shows the capital ratio impact. So the total bar is the beginning point, basically, and then the red bar is how much the stress test has reduced their capital ratio. This is looking at the Tier 1 common equity ratio and the severe stress, I believe. So you can see, again, as a result of the Fed models, this is the type of information that we disclosed. So we can move on to moving on to slide 20, we can take any questions we have at this point.
Okay, Christina, the number of questions has come in. How far back in history does one need to look for different macroeconomic variables in terms of looking at stress scenarios?
I don't think, we don't have a specific time frame that firms have to look back to. Like I mentioned in an earlier slide, we've looked back to the 1920s for some loss rates. It's really dependent on how much information we have and what you're trying to stress and what type of information you're looking at. So, you know, we're always trying to have the balance between using historical information but also being forward-looking and understanding that history is not necessarily a predictor of the future. I saw, you know, another question I saw came in that talked about how do we know the loss rates from the Great Depression are representative of future downturns. And obviously we don't know exactly what's going to happen, right? So we really just try to look back historically to see what's the worst that has happened and what effect that would have going forward. So we just try to look at it for information as to, you know, what could happen, what's the worst that has happened, and what could happen. And like I said, it's a balance between, you know, understanding that history cannot predict the future, but you need to use all the information you have. But we don't have a specific time frame that we require from that.
I mean, obviously, there's a need to balance the ability to look forward, right, as well as to make the scenario plausible. Not so straightforward from your perspective.
Yeah, and unfortunately not. I think we all wish it was more straightforward, but you know, like I said, it depends on, a lot of it depends on how much data a firm has. You know, once we introduce the CAPRA firms into the process, they're smaller banks with less data, so they have to do some more subjective analysis in certain cases and some like scenario analysis, which is more of a what-if type scenario where they look at external data from other firms if they don't have the data. So it really depends a lot on the firm and how much data they have and what they can use, but then also, like we said, the balance between historical perspective and forward-looking.
Okay. How frequently are banks required to submit their data to the Federal Reserve?
So there's a variety of different regulatory reports. They're called Y14 reports, and they're also on the board's website if anybody wanted to review them. The reports are either annual, quarterly, or monthly. So for firms over, these are also for firms over 50 billion that have to complete the Y14 reports. So, and the reports depend on the materiality of certain portfolios. So it really varies by bank. Even with the banks over 50 billion, they might have to only complete certain schedules depending on how large a portfolio it is. So then the annual reports tend to focus on stuff like the income statement, the balance sheet, and pre-provision extra revenue, and then the quarterly data gets into more loan level detail and more granular detail from the firms. And then for the firms over, sorry, just really quick, I remembered firms over $10 billion as part of Dodd-Frank. There's something that they're out for comment now. It's called the Y16 reports, and those are annual for firms between 10 and 50 billion. The Y16 report's out for comment now, and that'll be a requirement starting in 2014.
Mm-hmm. Okay, currently the big major banks, 19 under reviews. I mean, one of the issue is also looking at the regulators' ability to review all this data and information that's coming in from the banks. In terms of capability, could you share a bit about the structure at the Federal Reserve in terms of the capital analysis team?
Sure. We have, as you said, we get a lot of information from these firms, and it's a huge project. It's a huge exercise that we undertake every year. We have across the whole system, I don't even think we know the number, probably over 500 people that are working. Don't quote me on that, but I think we have a lot of people that work on it, and we basically have system teams that are, we have risk teams that are focused on all the firms. So there's a wholesale risk team that looks across the 19 firms, and a retail team, and a trading team, and an operational risk team. And then there's also teams that look at supervision, net revenue, and policy. So we have all these different horizontal teams that look at all the firms. And then at the same time, we have our on-site teams that are bank specific. So, we have a team at Citibank that's in charge of the process for reviewing that bank submission. So they spend all of their time on that one bank. So we do, it's kind of a matrix approach where we have a lot of people focusing either on a specific bank or people focusing on a specific risk or another area like revenue or policy. And then, we consolidate it. We have a lot of internal vetting processes. We get the submissions in early January, and it basically runs through the end of April when we give the feedback letters to the firm. So it's almost a 4-month process, and there's a lot of planning that goes into it before that. So it's almost an annual exercise at this point, and there's a lot of people involved. So as you could imagine, we get kind of information from all the firms, so it takes an army.
Right. Okay. So the process in terms of submission to your feedback letter takes about 4 to 6 weeks.
So we give an initial letter at the end of March, I believe, which gives the decision on whether we object or not object to the capital actions, so the actual distributions. And that letter just basically says yes or no. We either object or don't object to the capital actions. And then at the end of April, we give a more detailed letter, a feedback letter, which includes, in addition to the decision, it includes any issues that have been uncovered as part of the process and any matters requiring attention that we issue to the firms as a result of the exercise. So there's sort of a 2-part process: the initial decision in March, and then the more detailed feedback towards the end of April.
Okay, we've got a lot more questions, but let hold them back till the lessons learned that Anna will talk about next. Anna?
Thank you. So on page 21, when evaluating bank capital adequacy process, the Federal Reserve considers a number of so-called what we refer to as principles of effective capital adequacy processes. You see here a list, and I'll go through those briefly. And you can find more detail on those principles if you go to the CCAR instructions, which are available on the Federal Reserve's website. So the first is foundational risk management. The expectation is that the bank holding company would have a sound risk measurement and management infrastructure that supports its identification, measurement, assessment, and control of material risks that arise from its exposures and activities. Principle 2 is loss estimation. The expectation is that the bank holding company would have effective processes for translating their risk measures into estimates of potential losses over a range of stress scenarios. Principle 3 is estimating capital resources. The expectation is that the bank holding company would understand what capital resources it has available, and it would have an effective process for estimating available capital resources over a range of stress scenarios, the same stress scenarios that it uses to estimate potential losses. The next one is impact analysis. So here the expectation is that bank holding companies would have processes to aggregate those losses, those estimates of losses and capital resources, and to evaluate the impact on capital adequacy by comparing the aggregated capital ratios to the internally set capital targets and goals, as well as comparing them to the regulatory minimums. The next is capital policies and capital planning practices. Well, here the expectation is that bank holding companies would have a comprehensive capital policy, and they would have a robust capital planning practices for establishing their capital goals, for considering how much capital they would need to hold, for making decisions about their distributions and other capital actions, and also that they would have a robust capital contingency plan. We also expect, as we discussed here, that companies would develop the internal stress scenarios, and that they would have a good, robust process for doing so, that their scenarios would capture their unique risks, and also that they would be sufficiently severe. The next is internal controls. So the expectation with respect to internal controls is that companies would have robust, strong internal controls governing their capital adequacy process. That would include policies and procedures, change control, model validation, comprehensive documentation, and regular review by internal audit. And lastly, governance. So under governance, we expect effective senior management and board oversight of the capital adequacy process, which would include periodic review of the foundational risk management infrastructure, that would involve review of how the capital goals are being set, assessment of whether the stress scenarios are adequate, also review and understanding of all the weaknesses and limitations that could be inherent in different processes and models. Moving on to page 22. Here we come to the sort of conclusion of the CCAR process. So after reviewing company submissions, Federal Reserve makes a decision to either object or not object to the company's capital plan and also to the company's proposed capital actions. Those decisions are based on the factors that I described in the previous page. It's a number of qualitative and quantitative factors. So when we find that companies' capital levels are too low or they have certain deficient practices, then the Federal Reserve can cause the companies to curtail capital distributions. Capital Reserve can also require remediation of various weaknesses that were found in the capital plan and in the modeling framework. And lastly, in a more extreme case, a Federal Reserve could even require a capital raise. So you see in the box on this page the results of the CCAR 2013 exercise. For some of the outliers where certain deficient practices were found, Federal Reserve issued an objection to their capital plans. You see two companies where the capital plans were objected to, and their capital actions, their requested distributions, were denied. In two other cases, Federal Reserve also found some weaknesses but did not find sufficient ground to issue an objection. In this case, Federal Reserve issued a conditional non-objection to their capital plans, and those companies are required to resubmit their capital plans, having mitigate and remediate the weaknesses. Moving to page 23, CCAR high-level findings. Some of the themes that we've seen through the in the last exercise and through the previous CCAR exercises as well. So the first is severity of results. We mentioned that on several pages before. So we found that many firms struggled to fully reflect scenario severity. From the modeling standpoint, some models had trouble getting deep into the tail of the distribution. And overall, many bank holding companies estimated losses that were less severe in their analysis than the ones estimated by the Federal Reserve. Management judgment. In many cases, companies employ management judgment by making adjustments to the model outcomes, making overrides. They, as companies strengthen their model risk management processes, those overrides are diminishing, but they're still present. In many cases, they are tilted towards optimism. And even when companies have those adjustments and overrides, they're expected to have very strong documentation behind them and very good support for why they have them. Data challenges are still present at most companies, even companies going through several years of submission of data regulatory reports, and companies are still working through remediating and enhancing their data and technology infrastructure to be able to cope with those. Model validation. Model validation is still, in many companies, has exhibited certain weaknesses. And we still continue to look at the quality of individual model validations and overall governance over models. We're still finding certain issues that we are calling to companies' attention. Industry follow-up. We continue to engage very actively with the industry on outreach events like this call. In June this year, we held a second stress testing modeling symposium for the companies that participate in CCAR and for the ones that will be subject to the DFAST for the first time this year. We're also working on a paper that would describe a range of practice and expectations that's expected to be released shortly. So I think we only have one slide left. We can go over it quickly. On page 25, you see this is a roadmap, if you will, that shows you that stress testing is not limited to just one type. It's not limited to just enterprise-wide, but also this page shows you a number of Federal Reserve supervisory letters that describe expectations of companies to do stress tests in various other portfolios and risks that are material to their overall activities, such as you can see here, funding and liquidity risk, interest rate risk, leverage lending, etc. So I think with that, we can actually take questions.
Okay, thanks, Anna, for that insight. Now, we have a few questions that have come in on management action or remedial action on the submission of capital plans. Now, banks are asked to assess the ability to weather adverse market conditions, and they do so by relying on their own scenarios and valuation. And the Fed runs its own model against what the bank have done. Now, please share with us, how do you work with banks to reconcile the outcomes if they are different? You briefly mentioned about objection to capital plan and conditional non-objection to capital plan. Now, for the those that are objected to, are they required to resubmit the conditional non-objections? And Christina, if you can.
Yes, so after, if we object to the capital plan, then we require a resubmission. The timing is, it can vary by institution, and so we give a timing. It could be between, I think it's 90 days, but it really varies. When we give them the no object letter, we let them know. So we actually received some resubmissions back in June, and we're receiving a few more right now in September for the banks that were not objected to. So we do expect resubmissions, and we review those as well.
Okay, could you share with us, in terms of the resubmitted capital plans, you would have highlighted areas to act on. What's the experience been, and are there cases where resubmitted plans still fall short of requirements or expectations?
Yes, there are. So when we give the letter that says we object and ask for a resubmission, we specify what issues need to be responded to in the resubmission and which ones can wait until the next submission. Because, we understand that a lot of issues can't be resolved within 60 days or 90 days when the resubmission is required. So typically, if it's a quantitative issue with the capital ratios and capital levels and something more significant, and that can be fixed within a few months, we'll ask for that to be fixed before the resubmission, and then there might be other issues that we understand, might take until the next annual submission in January to be resolved. So we'll specify in the feedback what should be done for the resubmission, and then there are cases where the resubmission does still fall short. So we review those and give another feedback letter as well after the resubmission, saying what the result of the review of that is. Again, it's basically another review all over again.
Who in the banks, the submitting banks, are typically responsible for the process? Is it the CRO? Under whose authority, and how involved are the senior management? We talk about some of the management response to stress testing. Could you elaborate? And how does that kind of align to the Fed's expectation in terms of management involvement?
I can take this one. So with the stress test and with the submissions we receive as part of CCAR, there's a very broad involvement of a lot of people people and functions in banking organizations. It largely also depends on the size of the company and so how centralized or decentralized that organizational structure may be. So estimation of losses is something that's typically the responsibility of a risk function and chief risk officer. And estimation of available capital resources is typically, as we see, a responsibility of finance or treasury or chief financial officer. Firms also would involve, as I said, various control functions. Those are very important. So there will be an important role played by the model validation group to make sure that models are appropriately validated. There's a role for the internal audit to make sure that the overall framework has been appropriately tested. Senior management and the board, as I discussed in the principles of effective capital planning, are also involved in the oversight capacity. They expect to challenge various results presented to them. They expect to have an understanding of various components of the capital plan. So it's truly a very broad organizational involvement. It also involves many people at the business lines that may be collecting data or providing input or challenge to various components of the stress test.
Okay. Now, the stress testing requirement forces banks to analyze enterprise-wide loan-level data, focusing on cross-functional future projections. In your experience, how ready have banks been to do this, especially in the area of, you mentioned also data availability and in terms of technology?
Yeah, so as I mentioned in one of the lessons learned, data availability and quality of data is still an issue at many companies. The practices that we see vary a lot by the size of the institution, also by whether they are subject to Basel II advanced approaches or not. So those that are subject to Basel II advanced approaches have made bigger investments in improving their data infrastructure. So typically we see in their submissions that the data and the models they have maybe in somewhat more advanced stage. But overall, all companies have various issues in various elements of IT and data infrastructure and still working to improve those.
Okay, Anna, or Christina, we have a specific question on bullet point number 2 on slide 17. I don't know whether you can see the question that's come in.
Is that the one on the translating of the macro variables?
Yes.
So I'm not sure if everybody else on the call can see the question. So can you go back to slide 17 so they can see the bullet? So that just okay. So slide 17 just talks about the translation of macroeconomic variables and the methodology used. So
I'll just ask the benefit of the callers who can't see the question. Many banks outside the US have difficulty converting the economic assumption about GDP growth rates, unemployment, and house prices into detailed methodology that can be used for calculating estimated portfolio impacts and losses. So the question to you, Christina, do you have specific requirements about the statistical methodology that banks must use to translate the scenarios? That is one. The next question is, have you published any details of the methodology that Fed uses?
So no, we do not have specific requirements as to how to translate the variables. Again, this will differ by firm, and we really want to leave it flexible for the firms to be able to use their own data to correlate to the macro variables and see how the macro variables that we're providing fit the bank best. So we don't want to prescribe a specific methodology for them to use. We really look to the banks to come up with a methodology and then review what they do and review what they submit to us. So we don't have specific requirements, and we don't publish details of what methodology to use. What will be coming out soon is a range of practice paper, and that will talk about what banks have done in the past to CCAR exercises, and we'll give range of practice and some expectations and best practices as to what we've seen so far. So again, it won't prescribe specific methodologies, but it'll give an idea of what banks have used and what's worked well and what hasn't worked well. So that should be coming out shortly. So you can look to probably the link that we had on one of the slides that I referred to earlier. That will probably contain the paper once it's published.
Okay, so the Fed is not particularly prescriptive in terms of methodology used. Rather for the banks to adhere to industry best practices. For example, the Basel Committee on Banking Supervision has got best practice for stress testing as well. There is another question on performing bottom-up, top-down, or hybrid form of stress testing. So again, would we be correct to assume that the Fed is not particularly prescriptive in terms of how the stress tests are done?
That's right. We're not prescriptive about it. What we look to is that they're segmenting the portfolios at a granular enough level that they're capturing risk-specific information within those portfolios. So we're not prescriptive as to whether it needs to be top-down or bottom-up, but so it'll really depend on the size of the firm. You know, larger firms that have a lot more data will tend to do a bottoms-up approach since they have the data at the loan level detail, and they can segment by risk characteristics such as credit scores or loan-to-value ratios, and really get detailed into how they segment and what methodologies they use. But then for smaller firms that don't have a lot of data, they'll use more of a top-down approach and segment by larger portfolios and apply shocks to that portfolio level. So it really depends on the size of the firm, the amount of data that they have, what tools that they have that they already use for risk management. We expect them to leverage those tools. So, different banks already use different methodologies. So we don't want to be prescriptive because it's really not a one-size-fits-all process when you talk about stress testing. So we want to leave it flexible so banks can do what works best for them and for their portfolio.
There's another question on are banks required to estimate second-round effects? For example, a credit event triggering a market risk event.
So with respect to second-order effects, part of our expectations when banks develop scenarios is that they consider how, for example, market participants may respond in case of a crisis. So, and they may also, we also would expect them to consider how that some of the actions they may take may not be fully effective in the case of a stress that may be different from what happened in the past. So that is an implicit expectation that when they think through the scenario and how events may unfold, when they develop their internal own scenarios, that they take that into consideration as well.
Okay. Now, our final question for this session. Christina and Anna, could you share your views on the merits of public disclosure of stress test results? And in your opinion, what's the best practice? The whole aim of disclosing results to the public is to build and restore confidence in the financial sector. If you could share on that, please. Thanks.
Sure. So the Federal Reserve believes very strongly in the merit of public disclosure to enhance market discipline. And disclosures that are provided as part of the supervisory stress test, as part of the CCAR and DFAST, are meant to provide information to the public on the process that supervisors follow and give insight to how capital action, objective and non-objective decisions are made. The disclosures also provide a horizontal perspective across firms in the process and give public confidence in the results in the process. They allow various stakeholders, firms' counterparties, depositors, shareholders, to make assessments about firms' conditions. As we already mentioned, as Christina mentioned in one of the slides, at the end of the CCAR process, the Federal Reserve publishes two sets of results based on the supervisory stress tests under the severely adverse stress scenario. The first set is detailed results of supervisory stress tests for each bank holding company, including, as we discussed, stress losses, stress revenues, and the post-stress capital ratios based on the capital action assumptions that are required under Dodd-Frank Act stress testing rule. And then along with the overview of the methodologies that are employed for the supervisory stress tests. The second set of disclosures are detailed results using also the stress losses and revenues and post-stress capital ratios, but then the difference is that they use the firm's own capital action assumptions. The Fed also requires the firms to publicly disclose their own stress test results, as we said, and the qualitative information on their methodologies.
Okay. Christina, anything to add to what Anna has just said?
No, I think she covered it all. Thanks.
Okay. Okay. On that note, let me conclude today's session. We want to thank both Christina and Anna for their insight. Now, stress testing is essential to a holistic capital planning program, and is used to deal with the uncertainty of an event or scenario occurring that causes a breach of the risk appetite statement. Our capital planning program that helps them determine their risk appetite is ultimately the responsibility of the board, and it is the foundation of strong risk management. Stress testing together with strong capital planning should be integral to the ICAP process of banks. A good capital planning framework drives clear articulation of the organization's strategy and its attitude to risk. It will force understanding of the risk to which it is exposed and comfort levels, and help rebuild confidence in the financial sector. We've heard the evolution of the stress test and capital planning process from the Federal Reserve, and we've heard about the submission as well as how the Fed review the submissions, and some of the lessons learned. We hear that it is not a one-size-fits-all solution. The Fed is cognizant that banks have different scale and different type and scale of operations, and is not adopting a too prescriptive approach. Again, we would like to thank our speakers. A recording of this teleconsultation will be available on the Asian Banker website. So do visit the website, and if you'd like to listen to a playback of the session, we'd like to thank everyone for calling in this morning. Until our next event, we wish you all